afternoon and welcome to BizTech's Asian Midday Market Watch. I'm Brian Fernandez and with me is my co-host Samantha Voon. It's the 22nd of August and let's start by taking a look at the summary of market action in the first half of the trading day. And with that, Sam, over to you.
Thank you, Brian. So, Asian markets displayed a mixed performance as investors' optimism surrounding possible US interest rate cuts was tempered by the downward revision of the US payroll data. Now, while some markets posted gains, the overall momentum was limited with the reignited fears of an economic slowdown. Over in Japan, stock markets led the region with the Nikkei 225 climbing 0.34%. Now, positive sentiments was driven by strong service sector growth, fueled by rising wages, according to PMI data. Although manufacturing activity declined more than anticipated, the overall economy continued to expand. Now, this economic strength increases the likelihood of a further interest rate hikes by the Bank of Japan, BOJ. Now, this could challenge local markets, though companies focused on domestic demands may benefit. The upcoming consumer inflation data on Friday will provide additional insights to the economy. Brian, over to you.
And the broader market elsewhere in Asia, the picture, however, is less rosy. The Shanghai Composite Index slipped 0.04%. Investor sentiment towards China remains weak. In contrast, Hong Kong's Hang Seng Index managed a 0.45 gain, buoyed by a recovery in technology and e-commerce stocks, though it continued to bear the scars of previous losses. Now, South Korea's Kospi remained flat after the Bank of Korea opted to maintain its current interest rates, citing ongoing inflation concerns. Over in Australia, the ASX 200 edged 0.3%, and China and India's Nifty 50 is up 0.17%. Now, overall, investors' attention is now focused on Fed Chair Jerome Powell, who is set to speak at the Jackson Hole Summit on Friday. Now, although US markets received a slight boost from the Fed's recent meeting minutes, which hinted at increased support of a rate cut, the optimism was overshadowed by recent downward revision in US payroll data, now reigniting concerns about a potential recession in the world's largest economy. And that's it for today's market updates. Now, to bring insights and analysis into markets, we have our guest today, David Kuo, founder of the Smart Investor out of Singapore. Now, David, welcome to the show.
Hey, good afternoon. Tengah hari.
Now, selamat tengah hari, David. Now, there is a real buzz in Malaysia and Singapore around the special economic zone. And the whole premise of this is really about duplicating the success of the Hong Kong's Shenzhen symbiotic relationship. What are your thoughts about this, David? There's a lot happening now. The special economic zone incentives and details have now been pushed forward to the end of the year. Tell us your thoughts on this as an investor.
Okay, you and I have been talking about this for a very long time, Brian. And as far as somebody who watches corporate strategy, that is me, very closely, it seems to make an awful lot of sense. What you have is a hinterland, Malaysia, that has tremendous amounts of resources. And by resources, I'm talking about land and also human capital. Here in Singapore, we have a developed economy that doesn't have a great deal of land. And if you were a corporate strategist and you looked at these two places, don't call them places, call them companies, right? You've got Malaysia and you've also got Singapore, two companies. And you would say, you have something that I don't have, and I have something that you don't have. So wouldn't it make a lot of sense to actually put the two of them together? And essentially, this is really what they're doing. The only thing that stands in its way is politics. And if you can overcome that political barrier, which also includes things like taxation, financial aspects of the two currencies, for instance, then you would have a marriage made in heaven. And essentially what they're trying to do is to try and sort of iron out some of the creases between a possible, I wouldn't call it a merger, right? Because a merger would be the wrong thing to say. A possible combination of the two assets in order to make something better. What people are a little afraid of is that, is this going to be a zero-sum game? In other words, if I win, you lose. If you win, I lose. I don't think it's actually a situation like that. It could be a win-win situation for both, but they need to actually sit down and work out some of the finer details. The difference between this and the Hong Kong Shenzhen that you were referring to earlier on is that Hong Kong Shenzhen is one country, right? I mean, China has made no bones about it being one country, two systems. And so while they had their own little problems, in other words, a capitalist system and a socialist system, this is something that is slightly different. A lot of people have been very reluctant to talk about this for a very long time, Brian, because they know that there are political issues here. But if you can overcome the political issues, then I think, it makes perfect sense. I think both sides could actually sort of come out winning from this.
Now, David, one of the key things with this is the following. This is not, and both of us are old enough. Sam is a little younger, but both of us are old enough.
No, she's a lot younger. She's a lot younger than us.
And to see that this has actually been tried several times over the last 30 years. This time, however, it seems to be different. There seems to be, obviously, there's a change of guard. So there is there are less legacy issues to deal with in terms of leadership. You've got a new prime minister in Singapore. You've got a new prime minister in Malaysia. You also then have lessons learned from the past on why this didn't take off. So I'm, for one, and I'm from Johor, as I've mentioned before, I am much more positive that something will really take off this time, because the numbers don't lie. Labor market arbitrage alone, you are 1/3 of the cost for similar human resources in Johor. Land costs are like 1/10. And so that really can, it's not a 1 + 1 = 2. It's really a 1 + 1 could be = 4 because of the opportunities in terms of scale, in terms of costs, in terms of also then, as long as we can get the freedom of movement correctly, it also is a pressure valve for Singapore, particularly older Singaporeans that perhaps Singapore has become way too expensive. So if the mobility of people can be worked out, and that's a political issue, I think then this really will take root in a much more positive way.
Well, you make a really good point. And apart from the fact that you have two political leaders at the moment, Anwar over in Malaysia and Lawrence Wong here in Singapore, who tend to be more far-sighted, you also have a change of guard in terms of the King of Malaysia. I mean, the Sultan of Johor now is the King of Malaysia. And so therefore you have overlaying all of that, the King who is very pro-business, who is very business-friendly. And I think that will probably be a deal breaker. I think if you had a king who was slightly more reticent and didn't want to actually move forward, then I think there would be some difficulties. But because you have a king who is very pro-business and he can see what lies beyond any barriers that might be put in front of the two prime ministers, then I think, we could have something that is pretty powerful. And there was something else that was alluded to, and that is that it's not just the situation of Singapore and Malaysia. What you're actually talking about is Thailand as well. I mean, would you want to see a situation where Malaysia became very friendly with Thailand, and then they set up an economic zone between Thailand and Malaysia? Who would lose out then? It would be Singapore who would lose out. I think some of the more far-sighted businessmen here in Singapore have in the past already invested quite heavily in Johor. And I think what will happen now is that when you start formalizing some of the things, then I think that more industries in Singapore will think about moving some of their operations, not all of their operations, into Johor, because it would make a tremendous amount of sense, just as it did for a lot of Hong Kong business people, factory owners that moved their operations over to Shenzhen because it was just cheaper.
Now, David, before we move to Sam and talk about Jerome Powell, let me leave the audience with a little fact now. In Singapore, McDonald's buns are delivered every 2 hours in outlets. Those buns are actually made in Johor Bahru.
Is that why they taste better?
So they are delivered. It's real-time logistics. 2 hours because you save real estate space. You can build smaller footprint stores in Singapore.
Yeah.
And you have a large industrial, basically bakery in Malaysia. So go figure. That's one of the key things that's happening that nobody really realizes. Now, Sam, over to you.
Thank you, wise man. All right, so let's turn our focus over to the US for a bit, right? Because all attention is now on the Fed Chair Jerome Powell's speech this Friday, which will tell us a lot of things, right? So, David, do you think, in your opinion, that the rate cut will be coming in September, whether it be a 50 basis point or a 25 basis point? What is your view?
Well, I think there were a number of things that happened even before Jerome Powell will stand up and speak at Jackson Hole. I mean, one of them was the Fed minutes, and the second one was the downward revision in the number of jobs created over in America. And I think both those things provide us with some insight into what the thinking behind the Federal Open Market Committee is, the FOMC, that decides interest rates. What we're actually seeing with the rate setting committee is that they are a little bit concerned about a slowdown in America. And the latest job figures seem to suggest that the labor market is not as robust as we thought it was. I mean, they had to downwardly revise the numbers by 818,000, which works out to be about sort of 20-odd thousand jobs per month. It's not that significant, but I think it's the direction of travel that is interesting, which is that the labor market is not as strong as the FOMC or the economists originally thought, and that there is some kind of slowdown taking place. We're also hearing anecdotal stuff from many companies saying that even the well-off people in America are beginning to trade down. And so we saw these figures from Walmart that said that, well, they were beginning to see some of their wealthier clients selling their preferred stores and coming into Walmart because prices were cheaper. And so all of this points to the fact that, yes, it looks as though inflation is heading down, and the FOMC is very cognizant of that fact, that inflation is trending downwards. It hasn't reached the 2% target, but they're saying that if the direction of travel is lower, and if the labor market is showing signs of strain, then surely it is better to cut interest rates now rather than to wait until the situation is really bad and then you have to cut. But as far as Jay Powell is concerned, will he talk about an interest rate cut? The answer is no, because it's not up to him. It's up to the rate setting committee. But I think he'll probably sort of give a nudge, give a wink, and sort of say, yeah, it's pretty likely that we're going to be cutting in September. So listen for the narrative, listen for the nuances that he has during his speech. And if he does give a nudge and a wink, then I think we are probably going to get an interest rate cut in September.
All right. So how about things, the stocks shares over in the US market is hovering at an all-time high. Will this move up or down given the situation? And are we ready for a bear market if shares do head lower?
Okay, right. This is my article in the Business Times yesterday. Yeah. Are we ready for a bear market? And the simple answer is bear markets happen, Sam, right? It invariably happens. We've had, according to my calculation, we've had 8 in the last 50 years. Yeah, so 8 bear markets in the last 50 years, which works out to be about 1 every 6 years. The last one was in 2020, and so therefore the next one will be coming. Whether it comes this year, next year, or in 2026, we don't know. But I think the general consensus is that bear markets are nothing to worry about. They just happen. It is just like we breathe in and out, right? Economies breathe in and out. And because we've had interest rates at an exceedingly high level, stock markets have still managed to climb. What will happen now is that the Fed will try and manage or engineer some kind of soft landing. But the chances of them being able to achieve that, I think, is very remote. And so what will happen is that some of the companies in America are already contracting, and some of the companies are finding that it is quite difficult to generate a profit. So this will exacerbate the problem. And as interest rates come down, they're not going to have, well, it's not going to have an immediate effect on companies. And so therefore, businesses will start to see their profits beginning to contract a little. And as a result of that, investors will say, hey, you know, I don't really want to invest in this company because the profitability is beginning to deteriorate. And so it is just a natural process until such time that the stock market does come down. And what better time to sell than now when the stock market's at an all-time high? You don't want to start selling stocks when the stock market is at rock bottom, because where is your profit? But here's the thing. As a long-term investor, I don't really care about bear markets either being stock markets either being up or down. I don't care about bull and bear markets. I look at companies, I look at businesses, and I just say that you're going to be heading into a period of toughness, hardness, and can you tolerate that? I'm not talking about me, I'm talking about the business. As a company, are you able to tolerate that? And in general, strong companies will be able to tolerate that. Companies that have been around for 100, 150 years have seen loads of bear markets, but they're still around today. And that is really the key. You have to pick good companies, understand what they do, how they do it. Is the management strong? Are they able to cope with all economic conditions? If they are, stay invested and don't be worried about the bear market if it should happen. And in fact, what you should do is to buy more in a bear market, which is what I tend to do.
All right. Thank you so much, David, for your insights.
You're welcome.
We've been speaking to David Kuo, founder of the Smart Investor in Singapore. This has been BizTech Asian Midday Market Watch. I'm Samantha Voon.
And I'm Brian Fernandez.
Be sure to keep informed with the latest market updates weekdays at 1 p.m. This video and podcast will be on our website, www.biztech.asia, as well as our social media platform. It will also be on our syndication partners' TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.